The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and thanks for joining us on today's webinar. I'm Brittany Melville, the Director of Marketing and Sales for Next Generation. Sorry we're getting a bit of a late start. Just wanted to make sure we had everything in order here. And we are on deck to answer any questions that you have. So as we communicated when we sent out the initial email here, we're going to do this a little differently than a typical webinar. So rather than just presenting information one way to you, we'd like to hear what questions you have about self-directed IRAs, as we also realize that some of you may have experience already. Maybe you have clients or other individuals you're aware of that have used them, or maybe you have one yourself. So we want to make sure we answer the questions that you're really interested in understanding. And of course, we can always send some backup information or additional information to you following the webinar. We will be recording it, so if you missed it live today, you can listen in later. And if you registered, you will get a copy of this recording. So with that, I'm going to see if there are any questions that have been submitted. So for anyone who's not done this before, what you can do to submit a question is you can enter one into the questions panel on the right side of your screen here, or you can enter something into the chat box. So I'm going to look and see if we have anything yet. Okay. So we do have a question. This might be from someone that's sort of getting started and just trying to understand the differences here. What are the benefits of a self-directed IRA? So sometimes what's helpful is to start by looking at what makes these different from your traditional, brokerage accounts or other traditional retirement plans that most are used to, right? So typically with a retirement plan, like a 401k or an IRA, your investments are limited to publicly traded assets like stocks, bonds, and mutual funds. And you choose those, and you don't really have the option to diversify beyond publicly traded assets, right? So with the self-directed IRA or retirement plan, you are available to open up your options, and you can invest in things that are not publicly traded, what we commonly refer to as alternative assets. And those include things like real estate, private equity, notes, so basically private lending, partnerships, joint ventures, precious metals, investing in startup companies, or getting into the impact investing space. So that's sort of what differentiates a self-directed IRA from what most are used to. And the other main differentiator is the ability for the account holder, which is the investor, to make all their own investment decisions. So to basically direct the decisions being made around the investment. And that translates to typically having more control over the return on your investment, especially if you're someone who has existing experience in these areas of real estate or private equity. Hedge funds is another area that you can invest in with a self-directed IRA. And with that experience, you have a little bit more control over the decisions being made related to your account and the returns that you're earning within that, versus with a typical plan, you're typically sort of at the mercy of the market, which can tend to be very volatile. So you don't really have as much control over what happens if you have stock in a large corporation and they go under, or someone makes a decision that investors aren't comfortable with. It's very emotional. So those are really the main differences. And then obviously another advantage is the ability to earn tax protected returns on your investment. So where you might already invest in these sorts of things with your personal funds, when you gain on those investments with your personal funds, those earnings are taxable, right? So you have to report those on an annual basis, what earnings you've gained. When you do this in a self-directed plan, your earnings are either tax deferred if you have a traditional tax deferred account, or tax free if they're in a Roth. So there you have the ability to utilize the plan as more of a long-term tool. And then with that, you can shelter your earnings, especially if you don't plan on using them until you retire, inside the IRA. So hopefully that helps answer that question. So another question, how do self-directed IRAs work? So essentially, so what is the process? So I think these two kind of go hand in hand. So essentially, in order to set up a self-directed IRA, and people ask this a lot, how do I get started? You first need to establish a new account that is a self-directed plan. So if you have an existing retirement account with for example, Fidelity or Schwab, you don't really have the ability to hold these types of investments, and they typically won't allow for it. So in order to get started, you have to have a plan held with a custodian, which is what we are, that will allow alternative assets to be held. And typically, that custodian is specialized in the area of alternatives or self-directed plans, since the business model is a bit unique and different from other types of plans. So in order to get an account established, you would fill out an application with your personal information and other identifying information, and it's just similar to opening any other retirement plan. You would process that application through your custodian, and then they would establish an account for you. You typically be assigned an account number, and then once that account is open, which usually takes about a day or two to get processed, the next step is getting funds into the self-directed IRA that you can then use to invest. So your options from there are you can roll over funds from an old 401k, for example, or an inactive employer plan. You also have the option to transfer funds from an existing IRA that you might have. And that process would just require you to liquidate whatever portion of the funds you want to move. So in your current IRA, for example, if it's with Fidelity, you just need to make sure that, for example, if you're looking to transfer $50,000 from your Fidelity IRA, make sure that that $50,000 is liquidated before the transfer occurs, so it's in a cash position. And that can be moved from trustee to trustee with no reportable or taxable events. And you would then have a fully funded self-directed IRA with, in this example, $50,000 in cash that you can then direct for your custodian to invest in alternative assets that you choose for yourself. All right, and just to add to that real quick, there's another question, but just to add to that, what you should also expect when you direct your custodian to make an investment is that they will require certain paperwork from you in order to authorize any investment. So they're typically going to ask you for some paperwork that's related to their custodian's internal documents, so that you're providing them with your information and confirming the IRA that is to be used for the investment, and some particulars about the type of investment you're looking to do and how much you're looking to move over for this investment. They will also be asking for supporting documentation related to the investment. So for example, if you are investing in a startup company and you want to have 10% ownership in the startup, they would be looking for, if it's an LLC, an operating agreement, any subscription documents that you typically sign if you were investing. Those sorts of supporting documents would have to be sent to your custodian, and the investor, rather than your personal name, in this case would be the name of your IRA, your self-directed IRA, and the custodian would review these things for compliance with IRS guidelines. And they'd also be looking to make sure that they don't see any risk of a prohibited transaction. So although you can invest in just about any alternative asset, with the exception of life insurance and collectibles, there are other specific rules and guidelines you have to be aware of when you are doing a transaction with the self-directed IRA, so that you are not disqualifying your entire IRA and creating a taxable event. Let's see, I'm getting questions from a couple places right now. Can I use my self-directed IRA to invest in cannabis? Great question. So technically the answer is yes, but right now, considering that this is not legal or considered legal at a federal level, it is sort of a state-specific determination right now. So I can tell you with sadness that since our trust company is chartered in the state of South Dakota, where this is not legal, we are not at a position right now to be able to hold cannabis investments. Now, that doesn't mean that we won't in the future. So it's definitely an area where we're kind of looking to see what happens next. So we'll keep an eye out for changes. But once if that does become legal at a federal level, then we absolutely can. So I would suggest reaching out to your custodian of interest and ask that question. It's going to be specific to the company. Okay, so another question. What levels of due diligence am I responsible for, and what would be required of me as an investor? So I'm going to answer this sort of backwards. So what's required of you, I touched on a little bit of that from an investment standpoint as far as providing documentation and completing supporting documentation to be submitted to the custodian for that compliance review. That's definitely something that you need to be on top of. And to clarify why is with a self-directed account, your custodian is typically not a fiduciary, meaning that they're not financial advisors. They're a neutral third party that is motivated to do all of the tax reporting for your account and responsible for all the record keeping, but not necessarily selling any products or investments. So we don't, for example, have the ability to do that because we're not fiduciaries. So doing due diligence on your own investments is important, and that is the responsibility of the investor. So you still want to make sure that you're doing business with individuals that you know and trust, or companies that you know and trust, and that you've looked into and are aware of the risks associated with your investment, because any investment does come with risk. So that's one of the biggest things to really understand. And then also make sure that you're communicating with your custodian. If you have questions about anything, or if you're looking to get into a transaction or process any sort of a payment and you're not 100% sure if this is being done the right way, always check with the custodian first before you do anything. One of the other important responsibilities of the self-directed IRA owner is also to provide a fair market valuation on an annual basis of any of the investments or assets held within your self-directed IRA. So typically, with your traditional plans that are invested in publicly traded assets, since they're on the open market, it's very easy to value them on an even minute-to-minute basis, right? Or at least a daily basis. With non-publicly traded alternatives, the situation is different because these are considered by the IRS and, of course, I think everybody, harder to value assets, right? So, for example, a piece of real estate in an IRA needs to be valued on an annual basis so that we can keep the account information up to date. And in order to do that valuation, you will need to comply with certain guidelines to secure that valuation. It's not something that's in the scope of our services, but what we do when that valuation is provided to us is we typically ask for that in the first quarter of the calendar year, and we ask for the value as of December 31st of the prior year. So when you submit that valuation, we update your account with that, and we also report that on the 5498 tax form to the IRS, and that is something that we're obligated to do on an annual basis. So it is important for account owners to be aware of that responsibility, that they do have to be involved in that fair market valuation process. All right, let's see, what else do we have? Can I buy a house and live in it using a self-directed IRA? So the short answer is no, and it actually goes in tandem with another question here, which is what types of investments and transactions are off limits. So as I mentioned before, the only types of assets you can't hold in a self-directed IRA are life insurance and collectibles. But then when you look at the other types of assets you are permitted to invest in, you have to take it down a layer and also ask yourself, what is the relationship between the IRA or the self-directed IRA owner and the individual or individuals on the other end of the transaction. The IRS has a list of what they consider to be disqualified people from the self-directed IRA, meaning that the IRA is not allowed to do a direct transaction with them, and they're not allowed to benefit from the IRA's investment. So those disqualified people are typically your ascendants, descendants, and their spouses. So family members in a lineal fashion are considered disqualified. So an example of this, and to the question about whether you can live in a property that you own with your self-directed IRA, the IRS considers you personally to also be disqualified from your own IRA. So that means if you purchase, let's say you open a self-directed IRA and you purchase a rental property, you cannot rent that property out to yourself, any of your ascendants, descendants, or their spouses, any disqualified persons. And you're also not able to have them even perform any sweat equity on that property, which would be performing repairs, for example. Anything that would add value to the property that's owned by the IRA cannot be performed by any disqualified person. So typically when people are doing these types of transactions, they're looking at what makes the most sense for the IRA in the long run and not what's going to benefit me in the short run or benefit my family members. The idea being that the long-term benefit you get is once you've successfully, hopefully, right, successfully invested your self-directed IRA and you've grown the value of your IRA over time and those returns have been tax deferred or tax free in your account, when you reach retirement age, you have the ability to take distributions for your personal use. And idea being that if you've grown the value significantly over time, you're retiring with more money in your pocket. So that's really the idea behind this, is benefiting the IRA and a long-term investment and investment purposes only. So it typically tends to work best with more passive investments. All right, let's see. Do we have any other questions? Okay, oh, somebody's typing a question. Stand by. Okay, what types of fees are associated with self-directed IRAs? Great question. So the fees are going to be different than what you would typically see in a brokerage account or an IRA with, your typical custodian. So again, because I mentioned earlier, this is a different business model. And because self-directed IRAs hold assets that are all unique and different from each other, there's a lot more personalized service required to do what's needed to maintain these accounts and the assets held in them. So you should expect to see usually an account opening fee, a small one-time setup fee. You should also expect to pay a custodial fee, which is going to be the main fee that you'll be responsible for, depending on the custodian, and we actually offer multiple options for this. You can pay a flat rate annually, or you can pay a value-based rate, but that is going to cover, that custodial fee is going to cover the tax reporting, the record keeping, overall administration, statements provided for your account, and online access to your account, as well as ongoing support. So you're going to be responsible for that, and then there are also going to be transactional fees that may or may not apply depending on the activity taking place within your account. Typically, everyone's going to be responsible for a transaction fee when they purchase an asset or sell an asset. So if you're getting into a new investment, when that transaction is processed, there's a fee associated with that because it covers that compliance review we talked about earlier that your custodian needs to perform for you to protect the tax advantage status of your account. So those are fee, I would just say in general, those are the types of fees that you should expect to see. And for anyone who would like a copy of our fee schedule, you can actually view it on our website, or if you would prefer we email it to you directly, please reach out and let us know, and we can provide you with anything you need. And then, of course, if you have questions about any of that and you prefer to discuss it on a one-on-one basis, we could always have a phone call to go into that a bit further. All right, any other questions? Oh, I think we have another one. Can my spouse and I combine our IRAs to make a real estate purchase? Another great question. So this is a bit of an involved response because remember I said earlier that spouses are considered disqualified persons from your IRA. So on the surface, you're not able to commingle funds with your self-directed IRA and your spouse, or your spouse's self-directed IRA if you both had one. However, you do have the ability to partner into a real estate purchase where each member, let's just say it's your self-directed IRA and your spouse, 2 members, or partner, I should say, takes a percentage of ownership of that asset from the beginning of the investment and they simultaneously fund it up front. And those ownership percentages remain consistent throughout the project, and at the liquidation of the investment, those respective ownership allocations and are returned back to each of the partners. So for example, just for simplicity's sake, let's say a self-directed IRA owner and spouse would like to purchase a property and buy and hold this property, rent it out over years, and obviously their IRA, the IRA and the spouse would earn rental income over the years. But the purchase price is $100,000, and they decide they're going to partner into this deal. Let's say they decide they're going to partner 50-50, just for simplicity's sake, although it doesn't have to be a 50-50 split. At the time of the transaction of the purchase, the self-directed IRA contributes half of that, which would be the $50,000, and then the spouse contributes the other $50,000. Each of them are listed on the deed as owners of the property, and all expenses and income associated with that investment get split 50-50 throughout the entire project. Now, one reason that's important is because in this example, you have a self-directed IRA as a co-owner, which is a tax advantage plan. And then on the other side, you have a spouse, which is a person, which is a taxable person. So 50% of the income from this rental property going back into the self-directed IRA is going to be tax sheltered, and the other 50% going back to the spouse would be considered taxable. So that's one of the reasons it's really important not to commingle. But we do see partnering pretty commonly, so it's definitely something that can be done. You just have to make sure that you're aware of the guidelines and that you stick to those. And of course, rely on your custodian if you're not sure. Another question, can I do overseas investments in a rental property or land, like a vineyard, for example? Yes, you can. You can invest in foreign real estate. However, it is important to be familiar with the laws governing that country when it comes to real estate investments. So if your IRA is going to be getting into a foreign real estate asset, you do need to work with an ERISA attorney to make sure that the investment is structured properly and in accordance with that country's laws. So an ERISA attorney is not just any attorney. It is an attorney that is well-versed in the guidelines surrounding retirement plans. And an ERISA attorney should be familiar with the provisions that would need to be included in any documentation. So you definitely want to make sure that you work with the right attorney to do this. You don't want to put your account at risk, but you can definitely do so, and we do have clients that invest abroad. All right, let's see. I think I skipped one, so I'm going to go back to a question as they were coming in. I want to get started opening a self-directed IRA, but I don't have a lot of money. What are my options? So I guess that statement is sort of relative to the situation and the person, but if you, for example, don't have $100,000 to purchase a house in cash, there are lots of other options to use lower amounts of funding to do some more passive investing. So some other things we've seen clients do with less funding are private lending, which I mentioned earlier. So that would be, basically loaning funds out of your IRA to a borrower and earning interest and principal back on that loan over time. We also see people do private equity or sort of crowdfunding deals where a bunch of investors are going into a deal together and the minimum investment is a reasonable figure. So you don't have to be a accredited investor or have six figures necessarily in your IRA to do so. Same thing with purchasing private stock. We have clients that purchase stock in pre-IPO companies, for example. So we have clients that invested in Spotify before it went public. We have a lot of people doing Topgolf right now in the private stock space. Again, just a disclaimer that we don't endorse or recommend any specific investments, but just as an example of what we've seen clients doing to give you some ideas to get you thinking about your options, you still definitely have options if you don't have a larger funding amount. And of course, the idea would be that if you're starting out with a smaller amount, you're obviously going to passively grow that into something larger that you can then maybe put into bigger investments in the future. All right. I think we're caught up on questions. I'll give it another minute to see if any more come in. Okay, we have another one. They're rolling in. Let's see. I think I just lost it. 1 minute. Okay. Let's see. This one's a little longer. So I want to partner with someone to make a purchase and use qualified money from my IRA to get a self-directed IRA. My partner wants to use non-qualified money for his share of the purchase. Is this permissible? So yes, this would be identical to the example I went over earlier with the self-directed IRA owner and the spouse. So in that example, the self-directed IRA owner used qualified money to fund their account. And then the partner, which was the spouse, just used personal funds. So yes, it's permissible. Again, depending on it's more so related to the relationship between the partners, whether they're disqualified or not, that determines the rules that need to be followed. Let's see. Any other questions? Okay. Okay, we have another one. One second. I think we do. I saw something pop up and I can't seem to find it. Okay, can I roll over a SEP IRA? So if you're a business owner and you have a SEP IRA held elsewhere, you have a couple options. You can set up a SEP IRA that's self-directed, and you can move funds from your existing SEP into the new SEP. That could technically be done as a transfer rather than a rollover. Since if you roll over from one IRA to another IRA, you're only permitted to do that once every 365 days. But if you do it as a trustee to trustee transfer, you don't have any limitations as to the frequency. So it might be helpful to do that as a transfer, which we could definitely accommodate. So to continue, so you could set up a self-directed SEP and do it that way, or you could set up a traditional IRA that's self-directed with your new custodian, and you could transfer from your SEP to a traditional as well. The biggest difference really is just going to be that with a SEP IRA, your contribution limits are tied to your compensation. from your business. And that maximum amount you can contribute per year is 25%, up to a max of $56,000. With the traditional IRA, you're typically limited to $6,000 per year flat, or $7,000 per year if you're over the age of 50. So obviously the contribution limits could really vary depending on how much you're making in the business or how much you're paying yourself through your business, or whether your business is making any money and what makes more sense for you. At that point, it becomes a conversation that you'd benefit to have with your tax advisor, to look at your current circumstances, since every situation is a little unique and different, to determine which account type is best for you. But it's helpful to know that you can easily transfer between a SEP and a traditional IRA because they're both technically tax-deferred IRAs. So you have a couple options, and it's really up to you once you've spoken with your tax advisor to feel comfortable with your decision. All right, I think we're gonna wrap it up. I think we went over a lot of good questions. So what I would say is, for anyone that's on right now, or anyone who listens to the recording, if you have additional questions, please feel free to reach out. Or if you think that if you have a group of investors or clients that would benefit from sort of like a 101 on self-directed IRAs, we could do a more formal seminar. And we can do those via webinar for convenience. But if you think it would be valuable to have this education shared with anyone in your network, please do let us know, and we can discuss helping you out from that perspective. So with that, I want to thank everybody for joining today. You should receive an email from us within the next day or so as just a follow-up with a copy of this recording and a couple more resources for you to explore if you're interested in learning more. And you'll have some contact information on there as well. You can reach out to me or anyone on my team for more information. So thanks for your time today, everyone, and I hope you enjoy the rest of your day. Take care.